Have you ever looked at a star fund manager, someone with just incredible returns, and wondered, are they a financial genius, or did they just get really, really lucky? It's the multi-billion-dollar question in investing, and the answer might just lie in a single, powerful number. Let's break it down.
All right, here's our game plan. First, we're going to talk about the big problem that led to this whole idea in the first place. Then we'll pop the hood and deconstruct the formula itself. After that, we'll learn how to read its signal, uncover its crucial blind spots, and finally, we'll put it to the ultimate test with a true legend, Warren Buffett.
So, let's start with that core dilemma for any investor. You see a portfolio, maybe it's even your own, and it's posting these amazing returns. The big question is always, where did that success really come from?
I mean, is it pure skill and brilliant insight, or did the manager just take on a boatload of risk and happen to win the bet this time? You know, before the 1960s, it was almost impossible to tell the difference. High returns were just seen as a sign of success, but rewarding blind luck as if it's skill, well, that's a recipe for disaster.
And that is exactly where Jensen's alpha steps in. Think of it as a special tool designed to do one thing: isolate pure skill. It was created back in 1968 by Michael Jensen to strip away all the returns you'd expect just from the market going up and down and from the amount of risk you took on. Whatever's left over, that little bit of excess return, that's the alpha. That's the measure of a manager's true value-added contribution.
Now, to really appreciate how it isolates that skill, we've got to look under the hood at the formula itself. But don't worry, it's not as scary as it looks. We're going to take it piece by piece.
At its absolute simplest, this is all alpha is. It's just the difference between what your portfolio actually brought in and what it should have brought in, given the level of risk it took. The real magic, of course, is figuring out how we calculate that expected return. And the engine that calculates that expected return is a really famous financial model called the Capital Asset Pricing Model, or CAPM. I know, it looks a little intimidating, but it's really just putting that simple idea we just talked about into mathematical terms.
Let's break this down real quick. The formula starts with your portfolio's actual return. That's RP. Easy enough? Then it builds what you should have earned. It starts with the risk-free rate, or RF. Think of that as the baseline return you get for taking zero risk, like from a government T-bill. Then it adds a reward for taking on market risk, and that reward depends on beta. Beta just measures how volatile your portfolio is compared to the overall market. So a beta of 1.2 means it's 20% more volatile. If you take on more risk, you're expected to earn more. Alpha only gives you credit if you earn even more than that risk-adjusted number.
So once we run all the numbers and get a result, what does it actually tell us? Well, this is where alpha delivers its verdict on a manager's performance.
The final number gives us a really clear verdict. If you have a positive alpha, it means the manager actually added real value. They beat the risk-adjusted benchmark. A zero alpha isn't necessarily a bad thing. It just means the returns were right in line with the risk taken, kind of like a basic index fund. But a negative alpha? Yeah, that's a red flag. It means the manager didn't even deliver enough of a return to justify the risks they were taking with your money. Now, it's really important to distinguish alpha from other metrics you've probably heard about, like the Sharpe and Trainer ratios. Those are all about efficiency. Think of them like miles per gallon for your portfolio. They measure how much return you got for each unit of risk. Jensen's alpha is different. It's about the total absolute value added, measured in raw percentage points. It's not about how efficient the engine was, it's about how much farther down the road you actually got.
But look, like any tool, Jensen's alpha is not perfect. It has some pretty serious limitations, and every smart investor really needs to understand what they are. The criticisms kind of fall into a few key buckets. First, there's a big measurement problem called Rawls' critique. Basically, your alpha number is super sensitive to what benchmark you use. If you use the S&P 500, you get one number. If you use a different index, you can get a completely different alpha. Second, it relies on some shaky assumptions. It assumes a manager's risk level, or beta, stays constant and that market returns fit a nice, neat bell curve, which we all know isn't true during a market crash. And finally, there's survivorship bias. We often only measure the winners because the funds that fail and shut down just disappear from the data, which makes the average performance look way better than it actually is.
Okay, so keeping those limitations in mind, let's apply this whole concept to the ultimate test case, Warren Buffett. For decades, his performance was held up as the absolute gold standard of investment skill.
So get this, from 1976 all the way to 2011, Berkshire Hathaway generated an average annual return of 19%. And that's not just 19% total, that's 19% in excess of what you could get from risk-free treasury bills. That is an absolutely staggering number, almost double the market's performance over that time. For years, the entire financial world just kind of shrugged and said, well, that's Buffett's magic. It was seen as the ultimate example of positive alpha, a level of skill so deep, so profound, that it seemed to defy the idea that markets were efficient at all. But then, some researchers decided to dig a little deeper, and a landmark study found that once you accounted for a few very specific strategies, Buffett's magic alpha, well, it almost completely vanished. It turns out he was systematically buying safe, cheap, low-beta stocks. He was relentlessly focused on high-quality, profitable companies, and he was using the cheap, steady leverage from his insurance businesses to amplify those bets. It wasn't magic. It was a brilliant, repeatable system.
And this brings us to what might be the most profound lesson about this whole metric. What we once considered unexplainable skill, what we called alpha, can, once it's understood and turned into a system, just become another known risk factor, another beta. See, Buffett wasn't a magician. He was just decades ahead of everyone else in figuring out new ways to generate returns.
So while Jensen's alpha is an absolutely essential tool for trying to separate luck from skill, the Buffett example shows us that it's not some static final answer. As our understanding of how markets work evolves, what we once called genius can just become a teachable strategy. And that leaves us with a final fascinating question. If the goalposts for what counts as outperformance are always moving, what does it truly mean to be a genius?